Google just spent more cash than it made, not over a year, in 1 quarter. It brought in $39 billion from operations, and it spent about $45 billion on property and equipment. The gap was $5.9 billion in the wrong direction. That had never happened before. 87 straight quarters of positive free cash flow going back to the company's public listing in 2004. And then this one. In the same 3 months, the buyback stopped. Zero, against more than $13 billion a year earlier. Long-term debt doubled in 6 months, and the company sold stock for the first time in more than 2 decades. The market read it as panic. The stock fell about 7% the next day, and it took Amazon, Meta, and Microsoft down with it. So here's what this video answers. If the products still print money, and they do, then what actually changed? And when the world's most self-sufficient business suddenly needs outside money, whose account does that risk end up in? You've watched this company for 20 years without ever once worrying about its cash. That's the strange part. Google was the business that never needed anybody. It didn't borrow, it didn't sell shares. It made so much money that the hard problem was what to do with it. So it bought back its own stock year after year and still couldn't spend it fast enough. 2 years ago, the board authorized $70 billion of repurchases. The next year, it authorized another $70 billion. That's the peak. Buying back stock is what you do with money you have no better use for. It's the opposite of what a company under strain does. And for 2 straight years, it was Google's hardest financial decision. And it stayed that way right up until recently. Look at the free cash flow across the last 4 quarters, and you can watch it happen. $24.5 billion, $24.5 billion again, then $10 billion, then below zero. Watch the shape of that line. It doesn't wobble, it falls off a table in 2 steps. Meanwhile, the spending doubled. About $22 billion of capital expenditure in that quarter a year ago, about $45 billion in the most recent one. And this is where nearly every explanation you've read goes wrong. The story everyone tells is that this is an AI bubble, and Google simply overspent. It's a reasonable story. Capital spending really did double, guidance really was raised twice this year, and the market really did punish it. But it's measuring the wrong statement, and the company's own numbers show why. Step 1. Operations didn't weaken. They got stronger. If a company runs out of cash, you'd expect the business to be struggling. This one wasn't. Operating cash flow rose 41% from a year earlier. That's the money the business itself throws off, and it went up sharply. So the cash didn't disappear. Something on the other side of the ledger got bigger, faster. And this isn't simply what large technology companies do now. Take the other giant everyone owns. Across 9 months, Apple generated about $117 billion of operating cash and spent under $7 billion on property and equipment. Same economy, same year, opposite posture. This build-out is a choice, and the cash flow statement is where the choice gets recorded. Step 2. The funding source changed, and you can see the exact moment. There's one line on a cash flow statement called financing activities. It tells you whether a company is handing money back to investors or taking money in. A year ago, Google's was negative $5.8 billion, which means it was returning cash. In the most recent quarter, it was positive $61.2 billion. Watch that bar flip from below the axis to far above it. $20.3 billion of new bonds, nearly $50 billion of new stock. all in the same 3 months. And the raise moved fast. 80 billion announced on the 1st of June, upsized to almost 85 billion and priced the next day. Closed by the 5th, with Berkshire Hathaway taking 10 billion of it. 5 days. A company sitting on about $242 billion of cash and securities does not raise 50 billion in 5 days for a program it can still pace. Step 3. Ask the people who ran it. Because there's still an innocent explanation available here, and the people in charge gave it on the record the same day. The chief financial officer, Anat Ashkenazi, told investors how the company thinks about paying for all this. She described looking first at how much the build-out could be supported by cash from operations. That, she said, is the first source of funding. That's not a false statement, and it isn't hidden. It's just describing a different quarter than the one printed beside it. In that quarter, operations covered 39 billion of a $45 billion bill. The actual first source of funding was the bond market and the equity market. She also told investors free cash flow would remain under pressure because of the infrastructure investment. That investment, she said, is what lets the company capitalize on AI and drive attractive returns. Put that next to the 4-quarter chart. 24 billion, 24 billion, 10 billion, below zero. Under pressure is the mildest available description of that line. The chief executive, Sundar Pichai, put his name to the strategy in the release itself. Our AI investments are redefining what's possible across every part of our business. Take both statements at face value. A company that funds itself from operations first, investing while the returns look attractive. That describes a business making a series of quarterly decisions it could stop making at any point. Every explanation you've read assumes exactly that, including the bubble story, because both sides are reading the same cash flow statement. Which raises the question this whole video turns on. If the spending is still a series of decisions, why raise $50 billion in 5 days? Step 4. Read the footnote. Capital spending is a dial. You can turn it down next quarter if demand disappoints, which is what every analyst modeling this build-out assumed would happen. A signed purchase contract is a ratchet. It carries minimum quantities you pay for, whether or not you use them, a practice called take or pay. It adds substantive fees for walking away early. Same money, completely different freedom, which means two very different companies look identical on a cash flow statement. One has run out of money. The other has already committed it. You can't tell them apart until you read the footnotes. So the real question isn't how much Google spent, it's how much Google promised, and for how long. And that number lives in a different document entirely. 3 months before that famous quarter, the company disclosed exactly that. Long-term commitments, meaning contracts with more than a year left to run, chip supply, energy, content. The figure was $233 billion. 3 months later, the same disclosure, measured the same way, said $707 billion. Look at the gap between those two bars. Google added roughly $474 billion of long-dated obligation in 90 days. That's about 4 times everything the company earned in revenue that quarter, and more than 10 times what it spent on capital equipment. And it wasn't in the capex line the entire world was arguing about. It was in a footnote. That's the mechanism. The famous negative quarter isn't when Google committed to the AI build-out. It's the first quarter in which the bill for a commitment already signed showed up in the cash. The decision was made in a document almost nobody read. And these aren't intentions. The company's own note says some agreements run as long as 26 years, with obligations stretching to 2054. The energy agreements among them generally carry those take-or-pay minimums and termination fees. So the raise wasn't a company reacting to a bad quarter, it was a company paying for a signature. Now the honest part, and it matters more than anything else here, Google Cloud grew 82% to about $25 billion this quarter, and operating income rose 30% on a 34% margin. On the profit and loss statement, this is not a company in trouble. That's exactly why the funding line is the story. Nothing else is broken. And there's a real asset opposite those commitments. About $514 billion of signed cloud backlog. The commitment book is about 1.4 times that backlog, not infinitely more. Anyone showing you the commitment without the backlog is selling something.
So how big is the obligation, honestly?
Annualize the company's best quarter of operating cash flow, the most generous denominator available. About $156 billion a year. Credit half the backlog against the commitments on the company's own conversion disclosure. What's left is about 11.5 quarters of everything the business generates, already spoken for. And it's a range. Credit none of the backlog, 18 quarters. Credit all of it, about 5. Even the friendliest end is more than a year of everything the company makes. One more thing, plainly. Borrowing to build a supply-constrained asset at a 34% margin isn't recklessness, and the bet may well turn out to be right. The argument here isn't that it's wrong. It's about who's holding it and whether they chose to. So let's do the ledger. In a lawful, disclosed reallocation, whose claim on this company got stronger and whose got weaker? Suppliers and energy providers captured certainty. They hold multi-year contracts with minimums and termination fees. Google holds the obligation. And it went further than buying capacity. It also provided about $44 billion of backstops covering payment obligations tied to data centers. The buyer is underwriting its own supplier's risk. New bondholders captured a claim ranking ahead of every shareholder. Long-term debt went from about $47 billion to $98 billion in 6 months. Quarterly interest expense went from $261 million to $1.3 billion. That's a recurring cash cost that didn't exist a year ago. Existing shareholders lost twice. The buyback support went to 0. And here's what makes that a decision rather than a constraint. The board's authorization still had $69.5 billion available on it. None of it was used. That capacity wasn't exhausted, it was redirected. Meanwhile, the new shares and the convertible preferred dilute from the other side. In one sentence, Google created about $101 billion of new external claims on itself in 6 months, returned nothing through buybacks, and its profit margin never moved. And now the part that involves you. The 7 largest technology companies are about 34% of the S&P 500. The new debt and the new dilution sit exactly where that concentration already is. If you hold an index fund or a target date fund in a retirement account, you finance this by construction. You bought the index. You didn't buy the capex thesis. Nobody asked you, and nobody had to. One note on timing, because it explains why none of this looks broken yet. Google depreciates servers over about 6 years, so equipment bought this year mostly reaches the profit and loss statement from next year onward. Depreciation already rose 43% in the first half. The concession and the warning are the same fact, at 2 points on a schedule. Google didn't run out of money. It gave its money away in advance to 26-year contracts in a footnote, 1 quarter before anyone noticed. So here's what I'd genuinely like to know. If you own an index fund, did you consider yourself an investor in this build-out before today? And does knowing it change how you'd want it disclosed? And Google isn't the only one doing this. The other hyperscalers signed their own version of this quarter, and that's its own story.